Greetings, market rebels. Welcome to this week's macro measure combined with the sector situation. Again, this is Wayne coming at you here late on a Friday afternoon on the East Coast. It's just after 3 p.m. It is Friday, July 26, 2024, and we're keeping our stuff intact here with our trusty disclaimer, our trusty intellectual property rights notice, and the trusty way we've been going about things lately that I think has helped us out a little bit, which is just a very brief review and then getting into it. And I could save a lot of people time right now because this can't really be the way I approach things. This can't really be a heavy on the charts episode or installment. And that's because you've got this massive EPS deluge coming in next week. There's a lot of big names within it, and they're likely to set the tone, much like the ASML set the tone for maybe profit taking, repositioning, whatever you want to call it. So you can make all the salient points you'd like about the charts, and we probably will do at least some of that. But anyone that's been around for any length of time in the markets can tell you that if the overall tone on these conference calls and the results that are put forward by these companies, if they're very good or on the good to very good side, they're going to probably rally the market on that, and they'll probably do the opposite if the opposite's true. And that's really it. So let's get into the selective review. The side note is I kind of shared a personal take. I don't want to speak for my colleagues on something like this, but I really felt as though you need to be ready for volatility the rest of the year. This week, we had quite a bit of back and forth, but it wasn't really like last week. We did have, of course, more downside in the SPY and in the QQQ, two of the big four that we chart. So I guess that was worth keeping in there, but I still feel like this was more of a table setter for next week's EPS release, which is going to have many, many more names, much larger names. So that's maybe when the real fireworks could start. You could make the case that, for example, a lot of sectors are primed to go, and you could also make the case for, well, what if they fail because these players do not like what they hear on these calls and what they see in terms of results, and they decide to sell, and then you'll have lower highs that they sold or similar highs, so a double top. So right, it really all depends on the reaction next week in my mind. Some people might say, well, no, it's preordained to do this, and maybe it is, but that's not how I like to approach it. Anyway, the second one would be, I said thought we could see EPS reactions being used for impaling shorts and to levitate the market back up. But ASML, we've already noted, does that represent? And I would say, look, that's still possible, right? It remains to be seen. I don't think we've had that, but if they do, the reactions they had this week were not all that helpful for bulls, but they could still be, right? Because we're really hitting the big time release deluge, as I'm calling it, right? So I still think the ASML tone that seemed to persist in the SAMIs and tech to a degree this week, but the Qs and SMH really not having a nice bounce back week. When it comes to the dollar, 10-year yield and the VIX, we had said last week that they were all bid. It was the inverse of the week before. The complacency was gone with the wind, and that was on cue due to VIX seasonality. In retrospect, the VIX this week nearly made it to 20. So it did finally wake up from that slumber we had identified, I guess, like a month or so ago. It remains elevated at the moment. And so I would say that the market seems to be factoring in more volatility going forward from here. I don't really see much in the way of anything but noise in the dollar and the yields at the moment. They're kind of just sitting around, not doing all that much after backing off. Let's see here. We've got the repeat of last week, which we said still have the sense that off-camera developments are likely to shock this market more than what the market is ignoring. This applies to the next few months, but subject to change. So, yeah, I mean, the ignoring part is getting, I think, worse. You'll see that soon in the video. I think that would be something that really wouldn't be off camera, though. A lot of the things I'm going to show, it's off camera, I guess, to an extent, simply because it's not the kind of stuff that folks really focus on all that much on business television. They tend to be more about promoting this, that, and the other thing, rather than looking at the hardcore risk side of things, which is what, I think real firms, real traders uh, do, banks do, right? Focus on the risk side of the equation, but that's not really the TV approach and the commentator approach. A lot of people like to keep the punch bowl going, keep the punch bowl out there, keep the party going. Anyway, in retrospect, the market seems to have picked up on greater risk. So I think the market is suggesting, right, the way that the VIX has acted this week, that there is greater risk potentially upcoming. The market has not gotten back on track completely. And I think, as I've said, I think this week tells the tale as to what the next move is. And that is, is this just a pullback and you're just dealing with something, maybe liquidity just continues to drive it and FOMO continues to drive things? Or is this week sort of the pause, and maybe next week could be a rally, and then you maybe get selling after that because there needed to be some sort of a bounce, but you do get a second leg and you go from a pullback to more of a correction? That's, I think, one of the bigger questions that has to be answered by the future. We won't know, of course, until we get through probably the balance of the summer, the unofficial end of summer coming in early September. Bottom line trends are under pressure. They're still long-term up. There's no doubt about that. But we have to admit, when we see the charts, that support was cracked. We're still on the Esterhaus warning, AKA something along the lines of DEFCON 1. I would say, look, it was another rough week for the spiders and Qs, but the gang really spared IWM and the diamonds. So it wasn't altogether a disaster. They tried to prevent the week from ending on an ugly note. To my knowledge, here with an hour to go, they've largely been able to do that. It really hasn't fallen apart here late on Friday to this point. And so that would really have created an ugly note for next week. And on that, I would say, the earnings calendar is chock full. I'm sticking with my main headline being balance of the year, just very volatile. I just think there's a potential for all that. I do really still think that we're in risky times and that all hell could break loose. I don't think I've said anything along these lines I really this seriously since we maybe had in front of 2022. I remember feeling like, no, boy, this isn't good in front of 2022. And, we had a rough year. And a lot of these things just keep cropping up over and over again, and when you get into these kind of junctures. And so it's a lot of the same or similar stuff that I'll share, but, there's times to worry about this time and times to ignore it. And I think the times to worry about it seem to be coming up. They seem to be upon us because the ignoring phase has persisted for a while, and a lot of things are just worsening, which I think you'll see. So I would say, look, set your playback speed to 2x. Specific technical analysis points worth the time. I don't think they are this week, because I will make some points, I think, but it's just that I'll cover them. But I think if you want to save a lot of time, you can just skip the video. If you want to learn about what risks are out there that we've come across, recently, then that's probably worth your time if you want to appreciate the risk side. But with things being where they are, right, laying where we are right in front of earnings, I don't think, right, it's prudent to make even low confidence forecasts. I think we can talk about scenarios, which we will, but I don't really think that you make your big forecasts in front of EPS unless you've got some really good intel on how these EPS situations are going to shake out, what these conference calls are going to sound like. That's a whole different story. I just don't have the time to do it all, and I don't have access to a source that does it all for me. So I'm left, wondering myself. Anyway, this week was messy and mixed. I don't think the sectors did too bad overall. The former leaders, though, not a great week, right? And that would be your XLK, your XLC, and your SMH for me. So that's not really a good sign. I don't think breadth was really too bad. I think it actually improved a little bit. So they did sort of still fan out a little bit into some of these sectors. So there seems to be a little bit of true believers really hanging on, and maybe they're right to do so. We just don't know yet. But again, I don't know any, not sure if any of my technical comments will matter as much as EPS results, right? If we knew what those were, then we probably could do a better job on the charts, but we just don't, and it's just too big of a wild card. So I think the results and guidance are going to tell the tale, as I already said. And I also would reiterate for long-time listeners and followers, they know this is true, but when it becomes less clear, and I feel like we're at that kind of a juncture, and we've been here and there, right? Several times we've been there and back again, where we just don't have a good read on things. The crystal ball is even more cloudy than usual. And so I think the secret at times like that is to realize I'm in a market, right, that doesn't have a lot of clarity. I can't really count on this trend the way that I had been now for most of the last 9 months or so. And so what I'm going to do is just not go for the absolute gusto unless I really see the personality of the market change to one that's more forceful in the near future. So in other words, if things aren't all that spectacular in terms of momentum, and you're seeing a lot of fits and starts, and you're seeing some stocks gap up while others gap down on EPS, you're really in more of a volatile, maybe range bound potentially, who knows, but you're in more of a singles and doubles mindset. And I think that's the secret, that if you say, well, I'm just going to try to make some money, it won't be a windfall on most of the positions I take. But as long as I keep grinding out winners, right, through a tough, challenging environment, it will get easier again at some point when the trend strengthens in one direction or the other. So I think if you just sprinkle in a little bit of extra discipline dust on top of things, you'll be fine, to add to the singles and doubles mentality. The VIX seasonality really did appear on Q. It does tend to trend higher into the fall. So all the concerns that I feel like have really cropped up that maybe should be addressed and maybe will be recognized more by the market in the near future, potentially, it seems to be on Q, right? I do think that melt up scenario that I was thinking could happen here in July, and I was really thinking about this continuing into next week, and the week that follows, where you get just a ton of earnings, and that would really allow them to mark things up. Since we've come down, it kind of removes the melt up scenario. So, but you're still maybe in line for a bounce or squeeze, right? So, but I would repeat, right, that we need to know what's going to happen, and we won't know that until we get there in terms of EPS and guidance. So it has to support that, or it won't. It will, more likely, will not work. So the wheels are still coming off. The GDP number they printed this week is likely a fantasy to be revised down significantly. And the question becomes, if that really is legitimate, how do you go crying, to the Fed with your hat in hand and say, oh, we really need a rate cut, when you just clicked off a 2.8% quarter? But we'll see in the graphics that there's probably problems with that. It's been a long time, but I'm going to bring those back. We just don't have to go anywhere in terms of tabs, because I'm going to be sticking with the sticking right here. I placed a lot of these things in quickly this afternoon. So we'll see what happens. I think these are worth looking at, because EPS is a wild card. Could throw a monkey wrench into things. We don't know. We just don't know how it's going to break. So it's up in the air. I was a lot more confident that they would report really good stuff, at least backward looking stuff, about maybe like a month ago. But ever since what we've seen really in the last few weeks, it's hard to feel that way. Maybe the market's discounting that ahead of time, that it's not as wonderful as maybe it once appeared. But anyway, I'm just rerunning just to put things in perspective, because the alternative data conflicts with the official data, and you can see that you normally have this off peak, right? LEI, leading economic index, and usually, right, you're just in front by months in front of a recession. And you can note, right, that this goes back many decades. And when this shows up, right, when you peak and you roll over, right, this normally delivers a recession at some point. Well, you're 30 months from the previous peak. 30 months. So, and you're off very deeply. We've talked about it last week. So to say that something's overdue as per this and its track record, uh, is it an infallible track record? No, but it's pretty good. There's another thing we can look at though, and this is from Tavi Costa, and this is the, as he's calling it, the gold standard of recession indicators. And so we've got 76% of all treasury yield spreads are being negative right now. So you can see the prior history with the 70% threshold in terms of when you get yield curve inversions. And this has really never failed. So this has really been just in front of or concurrent with other issues. So this has been, again, fairly persistent. You can see that for a while. And yet nothing's really materialized, right? Yet, like, officially, or maybe somewhat officially, but that's a whole nother matter. Anyway, just to put it in perspective, well, what's been going on? This is from EJ Antony. And over here on the left-hand side, you can see that the nominal growth in GDP since the Q4 2020 is over here in blue. And here's the change in debt since then. So obviously, right, we are, and everyone pretty much, I think, knows this, but a lot of people are just addicted to it and expect it to continue forever because I guess it's continued really for so long. But the bottom line is, right, all we're really doing is going into debt to make it look as if we're really doing something, we're really growing. And so it's all related to the debt and the liquidity that's out there. And they just continue to do the same thing. And you just wonder how long this can persist for. But if you started fighting it when it first started happening, you'd be in really big trouble. So the timing, as always, is the big issue that we have to confront. In terms of another look from EJ Antony, you've got this collapse of new orders for durable goods. But the really interesting part is if you look at it nominally, it is rolling over. But you can see, right, what's happened in the past several years. This is if you inflation adjust things. So what they're saying, and the fact that they've even published it nominally, it's a really different story, right? We're not up 8%. We're really down 12.8% when you take inflation into account. And that's why so many people feel the way they do. That's why it's really embarrassing to hear so-called media types get on there and lecture people about how they should be feeling better about things, while in the real world, right, the red line or orange line there in the real world is what they're experiencing. It's just I don't know, ivory tower, whatever you want to call it, hubris, arrogance, who knows. But how people can get on there and say these kind of things when all you need to really do is use a little common sense and a little math, and you can figure out that it's not the story. The real story is not what someone published, it's what people are living. Anyway, Q2 GDP soars. This is really, to me, how do you, when you go with the final print from the Atlanta Fed estimate was, I think, 1.4. That was the Q1 print was 1.4 as well, but I'm pretty sure the Atlanta Fed pulled into somewhere near the 1.4 range. And yet what came out was a 2.8, so a doubling of that. This was a massive, as they say, 2 sigma higher, right? So massive miss based off of the consensus estimate. So there was only one estimate that was higher from the players that are involved in really this survey, or whatever you want to call it, this analytical breakdown. So that's that. It just shows you this is really an outlier. Don't think it's going to hold up. They've been doing this for a long time. That would be the federal government, where they publish a number. No one seems to care about the revisions, which always seem to be negative in terms of, if they're trying to make a number look rosy, it's much less rosy most of the time relative to what they print at the start. Excuse me. The Fed's favorite inflation indicator at the same time unexpectedly jumped in June as the savings rate slumped. So there's two more negatives, which really ties back into my question, which is, how do you start whining for a rate cut if you're claiming how that the economy is growing at 2.8%? It just doesn't doesn't, as they say, it doesn't add up. Another thing we can look at, and forget about the political parts of this, but this is really what matters, right? Just University of Michigan consumer sentiment slumped in July further, with current conditions punching to their weakest in nearly 2 years, 1.5 to 2 years. So that's a really big drop that's going on there with consumer sentiment. The credit card delinquencies are posted their all measures of balance-based credit card delinquency rates posted their highest levels in nearly the 12-year history of the series in the first quarter. So that's puts it right here, which I highlighted. And this is obviously coming from Zero Hedge. And then you could see you've got to go back a ways to, this is, I think, 2012. And since they've had percent of card balances accounts 60 days past due, and you're at the highest reading. So it's over a decade. So the whole thing about the consumer, right? The consumer's not feeling it here. Consumer is feeling it here on this side of this graphic. How does this show up in probably the most important area, because of all that really leads to home buying and all that follows home buying in terms of cash outlay and, excuse me, et cetera. U.S. new home sales unexpectedly tumbled in June as home buyer confidence crashes to record low. So that's record low. I mean, I don't even know what to say about that. That's doesn't really bode well, I don't think, right, for such an important area of the economy. That's why I'm spending time doing this. And you've got this buying conditions in the housing market have collapsed to levels only seen 2 times since 1960. Both of them ended in a recession. Housing market is a key leading indicator of the business cycle, which I tend to believe, which tends to react very quickly to interest rate changes. So this is some of your worst buying conditions, right, that you've seen. You're right back at them. They try to get away from here, but you're really still hovering near some of the very worst. You can see that when we do get into this kind of a deep dive on that, things are not good that follow, right? Or it's concurrent with bad times. So take it for what it's worth, but there's just another look at things. And then you've got credit card defaults from small lenders hit record highs. This goes back to the early 90s. So even crossing even the dot-com bubble and financial crisis peaks. So consumers are just getting in deeper. There are more new housing supply, right? More new single family homes or houses for sale than any time since February of 2008. So you've got to go back to really just in front of some really awful and wild times in the housing market to find a reading as high. So that's a lot of supply. And as they say, which I modified, buckle the bleep up. No kidding on that one. Here is it's coming in housing and no one sees it. 11% of U.S. consumers are 90 days plus in new delinquencies. FHA single family loans cited unemployment is the main reason, the most in over 16 years. So again, you've got to go back to some really rough stuff that was going on there back in 2008, 2009 to even compare to where we are now. So that just gives you an idea. So on that, I'm going to stop the share and going to reposition. We'll take a look at some charts and we'll come back and I'll wrap up things for with our bullet points. But you can see, I think, why I would bother going into that kind of trouble. And that's just some stuff, right, that we've come across, and just some macro stuff. Share screen 3. And yeah, so you've got some macro stuff, really big picture stuff. Just, it's not good. And again, you're barely removed, right? You're just, in terms of time, you're only a few weeks removed from the all-time highs in SPYs and in QQQ. And remember, we have to always remember that the stock market is not the economy, but ultimately it's very hard, right, for the market to advance if the economy is really falling apart and careening lower. So there is some sort of relationship, but when that relationship matters is probably the key as far as it applies to what we do and how we care about it in stock price behavior. So right now we're starting out here looking at just a daily of the SPY. And we have to note, and I'll just add some more time for us to be able to do this. We have to note here, I want to make sure it's showing the right thing really quickly here. Yep. We have to note that, look, we know that the trend is still up. I overdid it. Sorry, I think I might have been hesitating and I didn't realize it. You can still see the trend is, we can see that it's still up. There was that big low we talked about late last year, right, as we got into late October, early November. And by and large, it's really been up and away ever since. And it's been a heck of a run. But now we have to determine, and I'll try to make this a little bit easier to see. Now we have to determine, is this just another pullback in front of the heavy point in the earnings season? And if you wonder, well, why would you bring that up? Well, that's really, if you go back 3 months, and here we are right in late July. If you go back 3 months, you had just had this sort of heavy pullback into late April, right? So this is a little bit heavier of a pullback than the one we just experienced, but this is similar to what they did in front of the EPS. And if you notice, right, the EPS deluge that's about to happen over the next week and the following week are the two biggest, I think, but then it still continues on. But that's really what sets things in motion again and helps the trend hold and so on and so forth. So that's why I'm saying this catalyst is here, right? It is here just in time for them. And that's why I was saying if they would have held this up here and not really corrected much and gotten good results, they really could have melted this thing up if they had that scenario, but play out. But they didn't. They couldn't keep it in front of that. They couldn't keep it elevated in front of EPS. I don't know if that's a sign that EPS will not be that great, or it was just, hey, let's get the overboughtness out of this thing so we can have a much easier time of marking things right back up in the face of everybody that bailed out or went short or what have you. So don't know, right? But I feel like, again, the story is rates are coming down. The market's pricing it that way. There's no doubt about it. I'm not going to go to the CME watch tool or anything like that. But that's how it's being treated by the market. It's just that I wonder how they can reconcile that. How do you have this GDP print, and then what would it be? I guess 2 months from now, you're already bringing rates down, and you're maybe bringing them down 0.5 point. That would be something different. It could happen. I mean, it's not unprecedented, but it just talk about BS, right? We need to see inflation completely under control. Well, I'm not so sure it is. And what are you worried about if these economic numbers are purportedly real? Why would you be worried at a 2.8% clip, right? So it is what it is. It's unlikely that they would ever change and be truthful if they can get away with, as long as they can get away with not being so. But this is a big issue right now, is this big test of the 50 that we're on, and that's the rising gold line that you see, yellowish gold right there. So that's what we were thinking, right? It's very simple if you're an SMA person, when you're looking at an uptrend, and we say, in tiers wise, what happens if it doesn't hold there? Well, probably comes down to the next level. And what I like to do, and I've shared this many times, is I'm not so big on the SMAs, but I know a lot of people are. And I like to just dovetail it with other retracement levels from fib retracements, and also look at flat lines and things like that. And so that really can be, when you see a lot of support really bunching up, we could say, right in a similar location, that there's probably a lot of different traders that use different techniques that are ready to buy or cover shorts at that point. So it probably does bring some support in. But you can see that the recent plunge, right, yesterday's reading it was one of the worst readings we've had in a year. So you're right down there with some in terms of depth, right? You're on your rate of change and things like that, and the MACD numbers. This is probably some of your worst plunge that you've seen, other than here, right, and other than here. So it's not the end of the world. It's just that it did get overdone. We talked about short-term overboughtness yesterday, and that seems like it seems like they want to avoid an ugly close here on Friday, and keep things interesting, give themselves a better chance, because if you break certain levels and make new lows, it usually means that selling begets selling, buying begets buying. Right now, by holding the 50, if they can do this on the close, they only need about another 28 minutes of holding it to be able to do that. Then at least over the weekend, technically, there's probably less people that are inclined to want to just come in here on Monday morning and start pressing the sell button. For now, we'll have to see. You often can still get crossovers here that become problematic, right? So a lot of people still trade moving average crossovers, and you can see the aftermath of those crossovers really started here. The aftermath was there. So that's what I'm referring to. You're just getting these crosses. So if that really brings about more selling because people are trading it that way, and some people do, then you could have that visit to the 100. The Qs have already taken the visit to the 100. But like we say, we expect support to be supportive on their first touch, just without a really strong accompanying story of, hey, this is really bad, right? This is what happened. This is something you don't see very often in terms of really bad. You expect this to happen. Now, whether it holds, I don't know ultimately, of course, but usually you get there the first time and there's just this reflexive instinctive buying. But you could see that once you broke the 20 there in light blue, your next destination really became the 50 in SMAs. Your next destination is there. A lot of people don't chart that, but that's the 150 in rust. And then here's your 200 down there in purple. Excuse me. So remember, there's gaps all throughout this as well because of the nature of the way that these guys took things up. And that could come into play if they don't see and hear what they want to see and hear next week. It could really be a problem. So we just don't know yet. This is really not all that encouraging. Another thing I would say that's not all that encouraging, and I will show encouraging things too, by the way, but certainly the leader to me remains the SMH. That still looks vulnerable. We can say the good news is that, hey, look, just like the Qs, it is holding on above the 100, right near the 100. But again, it could clear the way. Let me just get rid of, I'll redo these if I have to. Let me just try to get rid of some of these fibs for now so everybody can see it better. Okay. Well, one more. I'll just get, well, you know what? I don't even know where I have that one from, so I'd rather just start fresh if I feel like we need to do that. But you've got this situation here, very similar, right? We talked about this with the negative divergence here on this second top. We talked about, I think, that at the time, big drops. Now, you're getting close to where the 20 may cross the 50 with more ugliness, and that's usually not something that usually means you're in store for more volatility, right? More downside, but also just more volatility back and forth where the market won't necessarily be settled right away too, if that should happen. Usually when that happens, you're in for more fun. But again, I don't read too much into any one thing. You can see on this sort of larger picture view in SMH, you have to really go back a ways to find some rate of change and MACD readings that are this bad. Rate of change gets down there. RSI not quite as bad as it's been in the past. It's still, because of how high it was, it still hasn't even gotten really to oversold yet. So it's got to come off more just based on the calculation. So short term oversold it was, but not on a daily, more of I think it was more of like an hourly that I was looking at when I made that comment yesterday morning. But anyway, this is bears and bulls could take something away from this. Well, we closed above the 100 we held. And bears would say, well, Problem is, you tried to rally and you couldn't get anywhere. You couldn't even eclipse the prior day's high, and they opened it and they sold it for most of the day because look at that candle, right? So we could sit here and do this back and forth, back and forth, back and forth stuff, but really, I'm still very obviously very concerned about the market because of the fact that there's these developments and these problems, and these were the leadership areas. But at the same time, I know that they can trump anything that I trot out in terms of technical analysis by having the big companies respond very well after maybe delivering very good results and maybe saying good things on these calls. I don't want to forecast that. I have no idea. Again, my lean was that they were going to be able to pull off more magic because they're American corporations, and that's what they seemingly do. Very consistently. So they're very good at. They're typically very good at that. But once they pop this thing through that, resistance line I just drew, what we have to do is see how this acts if it bounces up at the 10 in white, the 50 in gold, and then the blue and red, which are 15 is red, 20 is the light blue. There's a lot for it to get through there, but when they want to, right, they'll take it through. Sometimes it can take time, like it did here, to really put the right the ship, technically get those SMAs trending back up. But those should provide some resistance on the way down. Don't forget that there is a gap in here. So that's something you got to keep in mind if they start really moving this stuff back up. There's probably a lot of people, I would think there's a lot of people that have become encouraged by the market selling off, that think this market is out of its tree, shouldn't be anywhere near where it is missing all these tabs and graphics like we utilized today, and then some. Like, that's just a start. There's all kinds of things people can cite, and they're probably right about a lot of it, but that's why it's so hard, because you can be dead right about certain factors, but ultimately this is where all the scores are kept. And so you've got to get this part of it right, more so than being right about information or data. But look, gaps here, gaps back here where I'm putting my mouse. So there's plenty there for them if they want to pull things off, and really trounce this thing and fill gaps, or ramp this thing and get a lot of maybe fresh shorts, really super frustrated because they'll be saying, that's complete BS. And a lot of again, they'd be right with a lot of it. This economy's in trouble, and it is. But in the short run, these guys, it's their sandbox, and we're all just playing in it. But if you notice, right, all the things we've looked at, just they don't really look that good, right? You don't see any great signs yet of like, hey, there's a bounce that's going to happen. I mean, it could be something, but for my taste, I'd want to see more than what we see here, right? This is a little bit of a good sign that you got this overdone, but right, am I trading this for a bounce back to the new all-time high? I'm personally not doing that. I'm looking at going to do it iteratively. Okay, well, how does it react when it gets up to the 50? Can they get it above there and hold above there? What about the 20? Right? Can they close this gap and not just fade right back off, but hold it there? What about if they get it to the underside of this former support line? Then what? If they start doing things like that. So I'm going to do that. I'm going to entertain the idea that there could be a bounce, but it's all to me, it's all going to come from probably the mouths of the C-suite on these calls, because I think the EPS it might be just about what's expected this quarter, as just a gut guess, more like, well, it won't be that bad, it won't be that great, that type of thing, the way the market's been acting. XLC and XLK were also part of the leadership, as you all know, on the way up. They look very similar, and this one's faring a little better, and it's holding the 100, right? So these are the leadership areas that are a problem now, but a lot of other things look good. However, right, with only 20 minutes to go, one thing we should note right away is that the VIX is just not backing off into its little safe zone the way that it normally does. It's off on the day, but right? It's nowhere near that 11, 12 area we were talking about when it was just sort of trolling around down here. So again, I think the risk is being taken more seriously. Can they put all those concerns to bed with wonderful comments and results? Certainly can. I don't think it's going to be that great, but you never know. I think it's really going to be more or less so that kind of a reaction. But let me pull in some sectors so we can see what I was mentioning very early on in the video, and that was that I'll try to enlarge these as we go about. I don't need to show much, but hopefully everyone can see this. Hopefully you're not watching it on a phone or laptop, but you know, this is why this is so hard. There's times I think Greg likes to play the Kenny Rogers, the Gambler song in the Rebel Pit playlist. And I think it even came on today and right in front of the first hour of the webinar. And right, it's you got to know when to walk away, know when to run. That everyone knows that song. Anyway, you can see over here. Here's the leaders XLK and XLC, and they look how they look, and you can compare that to healthcare, real estate, financials, energy, staples, discretionary, transports, utilities, which have been affected by AI and crypto, and then XLI and XLB, right? So some of these things are bouncing and trying to get back and aren't far away from their recent highs, right? So that's similar. That's similar in a lot of these charts, right? XLV, XLF, XLB, XLI, even XLP, right? They all look somewhat like that. So what that tells me is that, right, they haven't fully given up on everything. There's still a little bit of a rotation happening in certain places that they like for now, but you could easily say if next week starts out, for example, let's blow this one up, XLF. If next week starts out poorly in the market and financials, you'd have a lower high, and then you'd be on your way to breaking this support, maybe with a lower low. So lower high, lower low, right? That's the possibility, at least of a short-term trend change. And you could have, if this rolls over here in XLP, you could say, well, that almost kind of like double topped, right? And another thing that's sort of double topped, not necessarily, but another thing that you could say, well, maybe that is sort of double topping. I think it would be, I was looking at IWM on, I think I was looking at that on what time? Yeah, daily time frame, and it's just too early to tell, right? Could you say that right now that well, I want it to be a little bit more, yeah, there you go. Is this maybe a double top here? We don't know, right? I think it's, again, this is what I'm getting at, is just too early to know. So could it be a breakout? Sure. Could it be a double top reversal? Sure, it could be. So, I mean, it's a good sign. I think we've been saying for a long time, right, that one of the missing elements is small caps. They backed off last week, but they've held their own this week. They're holding on to the gains they've had since last Friday, and they're right near, not too far from the closing high. So that's an area that still has a ton of potential in my mind, and it looks primed to go, and it's sort of acting well on a breakout fashion where you have the breakout, right, from all of your noise and consolidation triangle, whatever you want to call it. You break out, you have a nice pullback here, and then you hold, and then you try to go. So again, if things are starting to really get better, I'd be surprised by that. But again, they don't need to necessarily have confirmation from the economy to start positioning as if it's going to get better. Just remember that too. So again, the price action is it. You always have to guard, no matter what you're trading, whenever practically, you've always got to guard for, is it a false breakout? And that's why I always bring up the quick trim that I talked about. I won't bore everybody with it again, but the quick trim would help you there if you have a false breakout. Otherwise, right, you're holding everything, it reverses back down. By the time you decide I'm out on this thing, or whatever level you've picked out to have a little breathing room, you're going to probably turn it into what could have been a small winner into a loss. That's why it can be another reason why trading can be frustrating. But I'd still go with it, especially right if the rest of the market's looking good. And the diamonds are another part of it, another part of the market that is hanging in there better than SPY and the Qs. Now, I think SPY and the Qs are more important than the diamonds and the IWM in terms of what's really happening out there in the big picture of the American economy and so on and so forth. But we're talking about opportunities to an extent here, and this is acting better. Right? You can see this found support at the 20. It didn't have to drop to the 50 or the 100 the way the Qs and the spiders did. So this is hanging in there better, and so is the IWM. So those to me, right, are more primed to want to go technically and look better from a technical point of view. But again, bad news next week where they don't like it and they sell this market off. IWM looks like a double top. Meanwhile, the diamonds look like a lower high rollover and making, kind of a failed breakout where they tried to break out, tried to get it going again, couldn't do it and roll over. So it all depends. That's what I'm saying. It all depends on what these guys do, how they treat this market off of these EPS results. And we have had quarters where it hasn't been consistent, where some of the really big dogs that are heavy weights, they've some of them have done well while other ones have done poorly, and it sort of has balanced things out. I actually kind of feel like the first quarter results, to my recollection, were a lot like that, where it wasn't this clear sign that everything was really good across the board. So, and just remember, going back to SPY, this is what they've done before, right? Or Qs we could use. This exact type of scenario, just to a greater degree, happened, right? Where you got in, this was the first month where they start reporting after the first quarter. You have this slide, and then they start up and weighing it again after that, and then this is what you've got. So this is what you've got here, right? In this way things are falling chips wise, EPS wise. This time around, they could do the same thing all over again. So going back to everything, I don't want to beat a dead horse, but let me get the right. No, this is it right here. I don't want to beat a dead horse on making technical predictions, or if this does that, because like I said, no matter what happens, we're probably going to be trumped one way or the other by results. And if the results are really mixed, you could just get volatility. So I'm focusing on that and taking that breather to look at some of those graphics on the risk side, so that because I really believe that should sink in for people. It doesn't mean you do not trade as a bull. It just means that you got to be prepared if you are. And if it does get sort of dicey and messy and noisy, that you stick with that singles doubles mentality and realize that there could be a real rug pull happening at some point in this market between now and the end of the year, because of these problems that are building that I just don't see them being addressed. I don't, where are they, other than Janet Yellen finding ways to flood the economy with money? How are any of these economic issues being addressed legislatively or what have you? I don't see that right now. I mean, maybe it's out there and I'm unaware of it. I just don't see anything that's really going to move the needle, as they say. And as far as this goes, a lot of sectors are primed to break out if they get the go ahead to do so. Not all of them, but a lot of them are, and other ones are just still really struggling. They happen to be the leaders. Energy we should talk about, though. It's been a squirrely. I wonder if the IWM specialist is weaving his magic in there, because it's been a squirrely little number in there. You can see where we've been expecting this to lead to a breakout, and I guess you could say, well, if you want to do the glass half full, well, you've got a series of higher lows and higher highs. What do you want? Well, obviously, as momentum traders, we want things to persist and sustain a lot more than they have so far. And as far as the glass half empty, you're at risk, right? Because we're dealing in this snapshot on time right now. You're at risk of putting in a lower high right now if you roll over it, because you haven't cleared this yet. And then you could really be right back down, and it could really amount to just a protracted false breakout, as well. So That's not a good sign. Did see some data that suggested that there's going to be more supply coming online, I think is what I saw, slated for later this year and and next year. So I don't know, maybe that's already weighing on that market. I can't say because I don't follow it that closely. I just don't have time to. Let me see if I can get a market breadth look, and I'll show everyone that where is the market breadth chart on that one? I should have it right, maybe here. There it is. Just a simple look. Again, I have other things, but I don't want to get into things that are too far afield uh, and have to go into explanations on this. Just trying to get a general idea on things, and you can see that things have improved, right, with new highs and new lows. So again, even though the week has been a little bit rough on the SPY and the Qs, there's been a little bit of improvement that way, right? Where they haven't really completely abandoned the market. You could see that advanced decline cumulative averages and advanced decline line, these are all moving up a little bit. These are moving up here nicely. The comparison lines, right, with stocks above certain SMAs, those are all moving back up. So there's a little bit of repairing happening. McClellan oscillators repairing and moving back up, and everything's sort of looking primed to go. It's just that they don't have the clearance to do so because we haven't gotten what we need, which is next week to really be in the books and how that gets interpreted. So that's all. It's all there, right? And so this would easily flip if they don't. It's going to get maybe look a lot better and look really good if they do get the results they want. They're going to move things up, and all these things are going to go up. And if they don't like what they hear on balance, then they're going to probably knock these things down. So that's just it. It's a very, very tough situation. I wish I had more to say in terms of the technicals, but I don't feel like it's a complete waste of our time. You're just going to weigh this, weigh that, and ultimately, what you end up with is all roads lead back to the consensus EPS and commentary. And on balance, how does all that go? So to wrap things up, I'm just going to say I think the risks continue to grow. I think I tried to show some of that. The market currently is not shaking them off as easily as it was before. It could start doing that again. So we don't want to make a blanket statement like that's how it's going to be, because the market dynamics shift. I still think that there's a lot of things that are out there that could shock this market that it's not really, it doesn't seem to be paying attention to. The things that the market's ignoring, that some of them we covered, they're becoming more serious, but I do think the market could start paying attention to those, and that could also be a reason for selling. So I still think the off-camera stuff is what really could smash the market out of nowhere, more so than just, hey, things aren't as rosy as we think. I'd have a really, I think it's going to take real news to really move the market down in a big way, because you have an incumbent administration. They're holding their convention. I really would doubt that they want to see this massive 25% sell off or something like that in the stock market leading up to their political convention. And Janet Yellen, it's no secret that Janet Yellen's been flooding the market with as much liquidity as she can get her hands on, and that EJ Antony graphic showed how much debt, right, has accumulated, and how it really almost lines up very nicely with so-called growth, which again, a lot of it is being reported as nominal and it's not inflation adjusted. So it just the same old DC shenanigans being applied, maybe just more aggressively than is typically the case. So when that happens, it just seems over time every successive administration gets more aggressive with that stuff. I still think that these things are not just about the next few months, but I'm saying and I will change my mind if I think a lot of it's passed, but I don't think it has. I just think a lot of this is going to be with us for the rest of the year. Bottom line is the trend remains up, but we just, as I said, we don't know if this is a pullback or part of a larger correction yet. I think next week's going to really start to tell the tale. Because support is cracked, we have to remain on the Esterhaus warning or DEFCON 1 You could have more when you're in this, you just don't know. You could have a lot of back and forth and then further breakdown, or you could just have right the shorts get annihilated yet again. You just don't know. So again, the secret is just to go with it and adjust the best you can to changing conditions. And I think that clearly, I think that EPS fallout determines our short-term fate. Are we going to head back to it's just a swell summer like we were in? Or the question I would leave with everyone is, did the gang, because of how much they did push the market up this year, did they front run things too much too soon, right? And you had too much of a gain. So now you're going to experience a steeper drop or another leg lower. And so that's just something to think about. I'm going to leave the rest off the table for now because I don't think it's worth delving into. But going into the finer points in a time like this, to me, isn't really all that suitable. I think I could just as easily be convinced that they're going to impale the shorts the next couple of weeks as I could be convinced that no, reality really is starting to intrude upon this market. More players are realizing it. And despite solid reports, they didn't get enough enthusiasm on conference calls. So they're selling because they know the market probably got a little too far ahead of itself. So I know that's sort of bland stuff. But again, my experience has been is it's very true for me. I've said it many times for a long time. Watchers or listeners, you've heard me say it. When you have a hard time looking at charts and you survey everything, and you really have a hard time having a really strong lean in one direction or the other, you're probably reading things the right way. That is, you probably shouldn't have one, and you should just be very opportunistic and very willing to just take whatever comes your way and just jump on it with really something Greg reiterates in the Rebel Pit discussion all the time. Just trade what you see, right? And I just don't think we're set up in some way that we can overcome the unknowns of the next few weeks from corporate America. That's where we are. I would say if we had such a minor pullback, then I would probably have said, I feel a little bit better. We pulled back 2%, and that dawdled around for a little while, took the overboughtness out, and more than likely they're going to then goose this market even further on a squeeze. It'll be a melt up if they get the earnings they want, but that didn't happen. So I'm not really on board as much, even though you have to admit that a short squeeze after a couple of weeks of rough stuff it wouldn't be out of the question. In fact, usually July's are very good, and usually August has a little bit of follow through until you get in the second half of it. So that could certainly happen. So on that, we probably came in at an hour. Again, if you play this 2x, it might not be so bad. And as always, I do hope that something I've said helps you out this week or some week in the future. I want to thank everyone for tuning in. And I want to wish everyone a great weekend. If you get to see this video before the weekend gets into full swing, have a great, safe weekend, and have a great, hopefully safe week ahead in the markets. And everyone take care. Thank you one more time.